Hello and welcome to Fund to Money. Here we will discuss 5 important mistakes investors make in volatile markets in which prices are moving rapidly up or down, and that unsettles them and they may make these mistakes. So we're going to talk about 5 mistakes to avoid in volatile markets. Now, as we have mentioned in one of our previous presentations, prices keep moving up and down every moment in a market, but that should not be of concern to an investor, and investors probably don't focus on that aspect at all. But when the prices are moving up rapidly up and down, and investors are already invested and their investment values are going up and down, they get unsettled and they feel uncomfortable. And one of the reasons experts point out is why investors typically get nervous and they end up taking wrong decisions or decisions out of nervousness, which is not great for them, is they tend to overestimate the risk of losing everything. They think that it's going to lose everything when the markets are going up. On a broad basis, they think they're going to keep gaining, and when that trend breaks, they think they're going to lose everything, which is pretty unlikely, because if you're invested in different investments and different asset classes, so if you're invested in equities, debt, gold, and within equities you have invested in diversified equity and mid cap, small cap, and into themes, that's absolutely unlikely that you're going to lose everything. But that's a lot of behavioral aspects come into play when you are actually investing in volatile markets. For most investors, that happens. So people end up thinking that they're going to lose everything. That's not what is likely to happen, or what happens on an average. And this is where behavioral biases come into play. So there's something called the affect heuristic or affect bias. So basically, current circumstances are actually making you emotional, or making you happy or unhappy. They're making you feel something more risky than they actually are, than actually is risky. Or it is, in other cases, it could affect bias could make you look at things which are more risky, but you end up feeling that they're less risky. So what's happening is your emotions are taking over, whereas in investments, it's logic and information that has to play the role. And most of the mistakes that we're going to discuss have this common aspect. The logic and information and analysis is getting replaced by emotion. So what you need to do, even as we talk about these mistakes, you have to make sure that you come back to hardcore information, accurate information, not people's opinion, information. And then of course analysis has to be from a credible source. If you're qualified, you do it yourself or do it with somebody else's help. So most of the times what happens is you really don't need to do much. It's typically a temporary situation, some market condition, some development has happened, and it can be seen through. It doesn't warrant any kind of reaction in most cases, but because your emotions are overtaking, getting the better of you, and you end up doing something which is not really in the best of interest, and definitely not in the long-term interest. So number one is, of course, people take panic based decisions. So as you mentioned, people end up overestimating the risk, and they become pessimistic, and the affect heuristic, which is current circumstances actually influencing whether you feel happy about something or unhappy about something, and you taking investment decisions based on that comes into play. So what you need to do is make sure that you ask yourself whether you need to do anything at all. Most of the times you don't need to do anything, and if you do something, get credible information, accurate information, get advice, and then act on it. So most of the time that could be a temporary condition. If you have to do something, then you have to get a fix on the information, and then you act on it. Then of course the other part is not keeping your financial goal in mind. So most of the time, as we are saying, that if you have what keeps you grounded is your financial goal. If you, as an investor, are investing, then you should be having some kind of financial goal in mind. If you have invested in equities, it could be for retirement, children's higher education, and so on and so forth. And now, the question that you need to ask is, how is this current development actually affecting your financial goal? If your financial goal, which is retirement or children's higher education, one of them is 15 years down the line and the other is 20, and there's a market up and down, volatility is happening, it doesn't affect those goals at all. So because you're overestimating the risk of losing everything, therefore you're feeling compelled to do something. You don't need to do it. If you ask yourself whether this is a temporary thing or not, you probably get an answer that it's yes, and you don't need to do anything. If you need to do something, you probably need to tinker the risk, because when the markets were moving up, you completely lost sight of your financial goal, and you started investing more and more in equities. Now it's you've taken up a much higher risk than you would have otherwise have done, and therefore you need to correct it and make sure that the risk comes under control. You invest in other investment classes with lower risk, and that's how you rebalance your portfolio so that you can sort it out. However, the important part here is also behavioral biases at play. So people also are into herd mentality. They're following the herd. That's another bias. You end up doing whatever other people are doing. So if everybody's selling something, you're selling. If everybody's panicking, you're panicking. You don't need to do that. You need to ask yourself, do I need to do whatever other people are doing? And you'll find that you don't need to do anything. And in any case, if you need to do something, it's not what others are doing, because you will have your own distinct set of investments. You will have your own distinct set of goals. Both need to be aligned, and they both need to match up, right? So if you don't need them, one of the key things that you need to ask yourself is, in such condition, do I need the money tomorrow or day after? Because if you're selling off, which a lot of people end up actually doing, they don't even sell off half of their investment. They end up selling everything. So you ask yourself, do you need the money tomorrow or day after? If you don't, you need to stay invested. Remember, more volatile the investment class. So if it's equities, so if it's more volatile, the chances of the risk of you making a loss during volatile periods is that much higher. So in an equity, if in an equity investment in a volatile period, if you sell off, chances of your making a loss are that much higher than when the markets are reasonably moving in a range bound. The chances of your making a loss then will be far lower than if you are selling off in a volatile market. So these are things where you need to keep in mind. So you need to also ask yourself, are you comfortable with the risk? And if you're uncomfortable, then after analyzing information, getting the information, analyzing, and then you take a proper decision, and you don't need to have a knee-jerk reaction, right? Then of course the whole bit is about excessive monitoring. So when the markets are going up and down, people excessively monitor whether the market has gone up. You're checking out every hour. So what happens is, you are just reinforcing the nervousness and edginess, and you end up making a mistake, because emotions are taking over. You're not being able to analyze the information and take a calm-headed, logic-based decision. So what also happens is, another bias comes in and takes over, which is called loss aversion. This is another behavioral bias. So you're very averse. You suddenly become very averse to losing money. So basically, what happens typically in markets like these, volatile markets, your aversion to losing 1,000 rupees is far higher than the joy you will get from gaining rupees 1,000. So because of loss aversion, what actually happens is, because you're overestimating the risk of losing everything or losing, and then you're also averse to making a loss, you're actually moving out of investments, or you're staying away from investments, or reducing those investments, which will give you high growth. Remember, high growth investments like equities are also highly volatile. They are typically volatile in the short term, but as you go along, so if you've invested something in equities right now, first 3-4 years, there'll be a lot of zigzag movement, a lot of volatility. But the investment that you made today, when they come to 7th or 8th year and onwards, then you'll find they're average return that they've given to you is likely to be far higher than alternatives. So this is something that you need to keep in mind. If you stay away from high risk investments, remember, for a reasonable period of time, then the large savings that you need for major financial goals, you're likely to fall short. So therefore, the key part is to understand what is the period you need to stay invested in high risk investment, more volatile investments, and of course you need to be mindful of the individual investments that you're picking up and the mix that you have. Right. So we'll take a short break. On the other side, we'll be discussing the final two mistakes people make in volatile markets. Don't go away. Welcome back. Welcome to Fund to Money. We are discussing common mistakes people make or investors make in volatile markets. We already discussed 3 of them. We're going to discuss 2 more. There are a lot of experts who will tell you 10, 11, 20, and so on and so forth. So no quibble over that. But these are the 5 which we thought are worth pointing out, and they're so common and they're so manageable and they're so avoidable, then that it's definitely worth a discussion. And in the period that we're going to see in the days to come, it's worthwhile remembering these, being careful about these mistakes, right? So let's talk about the next one, which is premature exit. You're actually, we have already talked about this. In highly volatile investments are also highly rewarding, in that they tend to reward you in the long term. Equity is a brilliant example. And now, if you quit them before at least 8 to 10 years. On an average, then what happens is you need to stay invested in that asset class for that matter. Not talking about one individual security, individual investment that you can figure out. But if you remain invested for a certain period, in this case 8 to 10 years, that's when you get the returns. So because of the herd behavior bias, because of loss aversion, affect bias, what's happening is it prevents you, because emotions are taking over, the biases are taking over. So what's happening is preventing you from making the most out of these investments. So you need to make sure that these emotions don't come into their way. You're actually following the fundamentals and the basics. And remember, and you need to be careful of the games that your mind can play with you. Okay. Now, a very key part is when people move out of premature, they make premature exit because they feel that the risk of, they're overestimating the risk of losing everything. So they're moving out. A lot of people think that they will come back at an opportune time. The markets are low and then they'll do well. Now that is a pure fantasy. Most people, or rather almost everybody, fails. Don't even try that. Smarter are the people who are investing in something like a systematic investment plan, or you're doing stuff on your own. Then what happens is you are, regardless of the situation, markets, you're constantly doing well. Your investment and what the final outcome has got divorced. They're detached, decoupled from market conditions that will come up from time to time. So you don't go crazy when the markets are going up. You don't go crazy when the markets are going down, right? So timing the market is avoided, and unwarranted pessimism that creeps in, that also you're taken care of. What happens is that when the markets are going up, even if they're volatile, there's irrational exuberance, which some people call it. There's no logic behind some of the exuberance that you're exhibiting. You're buying more equities. You're not paying attention to details, fundamentals. So those things happen. Those excesses do happen. But this is a mistake that people can make, and this is something they need to be careful about. Then, of course, the other is disrupting regular investment. So that again is linked to your financial goals. If you disrupt your regular investments because you overestimate the risk of losing everything, you become loss averse. You're following the herd. Then what happens is you're losing out on time. Right? Remember, every financial goals needs a certain time for you. You need to give them money and make regular investment and need that money to grow over a certain period of time. Once you move out, what happens is you're depriving yourself of the time you have at hand. So then what you need to do is either you invest more regularly, or second is you'll have to take more risk. Maybe you'll have to do both. So what is basically happening is when you move out of the market because of loss aversion and some of the other behavioral biases, what's happening is you're actually hurting yourself. You're keeping yourself open, you're keeping yourself vulnerable to more dangers, more risks in the future. So don't stop investing, and remember which mutual fund investors would tell you who are into systematic investment plan. That when you're investing regularly, volatility actually helps, because when the markets are low, you buy more units. When markets are high, you buy lesser units. The average cost goes down over the long term. Mutual fund investors will tell you that. It's an established wisdom which a lot of people like and what a lot of people follow. And so you need to have a logic like that, where market conditions are not actually determining how you're going to invest, but you have a logic which is evergreen. It works across any kind of market conditions, because your needs will come up at a certain time. You cannot be telling yourself that you're going to retire 10 years later, because there were 5 periods when the markets were not great, right? So you need to keep all this in mind. If you need to do something, then you obviously need to do something of the risk level, the mix of your investment. That is the smart way of rebalancing your portfolio. That's the smart way of managing risk and volatility. Looking at individual investment, looking at your mix, that is the smart way of managing risk of your investment and your volatility, right? So this is roughly these are roughly the 5 major mistakes which investors make in volatile markets. We hope you found this useful. If you've liked it, hit the like button and share it with others. Till the next time, take very good care of yourself, and goodbye.